Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And with the volatility that we've seen here this week in equity markets, we are pausing our regular options education session and focusing this week on timing and trading volatile markets to try to give everyone a better framework for how to navigate this current volatility that we're finding ourselves in this market. So every single Thursday afternoon, we are dedicated here at OptionsPlay to help empower you to trade sustainably and confidently. Our goal is to make sure that you have a well-rounded education for your trading, not just specifically focus on options, but making sure that you have access to tools, making sure that you have access to the right educational resources to help you grow as an investor. And as you can see, many of you have already chimed into the chat window saying hello. So if you're joining us for the first time here at OptionsPlay, feel free to chime in. Let us know who you are, where you're from. As you can see, there's a vibrant community of traders here, all seeking the same thing, which is to better themselves as traders. And we are hoping that for those of you that are joining us for the first time, you're going to find this valuable to help you navigate the overall markets. Now, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as examples during today's session. So the goal for today's session is to largely help you identify actionable trade ideas during a bearish market. You can think of it whether you want to think of this as a bear market, or if you want to think of this as a volatile market. I think that those two terms can be used synonymously. Right now, we certainly are not yet in a bear market. We could potentially be, but we'll see where we land with regards to the market volatility. We'll certainly look at markets from a macro perspective, what my views are. But more importantly, what we want to talk about is understanding the characteristics of a bear market and some important statistics for trading them, because they are very different in nature to bull market. And we do find ourselves in a bull market more often than we find ourselves in a bear market or volatile market. So it's important to understand that bear markets are not simply just a mirror image of bull markets, that they are statistically and characteristically very. How are they different? We'll help you define that. And then what we'll look at is identifying optimal trading setups for a bearish market. I'll show you how you can utilize platforms like OptionsPlay to screen for opportunities and specifically what type of opportunities here at OptionsPlay. So for those of you that are joining us for the first time, I think one of the common questions or one of the most frequent questions that we get during these sessions are, can you get access to the recording and the slides? And the answer is yes. They're all available to all of our customers. You can sign up for a free trial to OptionsPlay, which is the platform that I will be showing you during today's session, that you can use to screen for bearish ideas and counter trend ideas during these types of bear markets that I'll be showing you for today. To access all of that, you can get it for free at optionsplay.com/signup for 30 days. Check it out. Make sure you feel comfortable with it before you choose a subscription that might suit you. Otherwise, you can just sign up and get access to the recording and slides so that you can follow along at your own pace. We typically post them on Sundays after each Thursday education session. So let's jump right into it. Before we kind of talk a little bit about bear markets, I do want to talk a little bit about where we currently stand in the equity markets, because I think a lot of investors are asking, what is the volatility we saw at the beginning of the week a sign of more to come in terms of volatility, or is this potentially the end of the worst of it, if you will? So if you look at the S&P 500, we managed to pull back to this 5140, 5150 support level. So this was a resistance level at one point that has now turned into support. You also have the 150-day moving average coming in here around 5150. I'm sorry, 5200, acting as some support here. So far, equity markets have held these levels. We obviously had a nasty few days in terms of a sell-off, but so far, subsequently, we've had 3 strong days. And the job report this morning, jobless claims, there was a lot of nervousness going into um, that number, because what drove a lot of the volatility was the unemployment number that came out last Friday that spooked investors. That concerns around the strength of the U.S. economy, concerns around the cooling labor market, and whether or not the Fed had waited too long to cut interest rates. I would say that the job numbers this morning alleviated some of those concerns to some degree, which is why we saw the S&P have one of its best days since January today. So overall, the equity markets, while suffering some pain this week, so far has been holding strong at the moment at these major support levels. Note that the RSI, very infrequently does RSI on the S&P 500 get to this 30 level, and they, generally speaking, have been pretty reliable buy signals here. Sometimes you get a short rally with a further decline, but overall they've been pretty strong buy signals here on the S&P 500. That's exactly what we got here as of Monday's open. The other metric I want to pay attention to here is the VIX. We had VIX spike all the way up. We opened up around 55 on Monday. It did intraday spike as high as 65, but as you can see right now, we're trading around 25 and a half or so. It's still the highest level we've seen over the past year prior to this recent spike. But we have reached what we typically would call a panic level of selling on Monday. And subsequently, now that we've retreated back to this $25, 25% level on the VIX, that typically would coincide with that typically would suggest that the panic selling that we saw is over, that we're less likely to see more of that continued violent sell-off that we saw here on Monday. It's not meant, it doesn't mean that it can't happen again, but certainly the chances of that happening now are far more subdued. So if you look at the fact that the S&P 500 so far has held the major support level, VIX have certainly reached kind of your fear panic level and have pulled back from it. That in itself gives me some confidence in that the fact that the equity markets will likely find some stability near where we are right now. Now, if you look historically speaking at the VIX, when you do get these big spikes, single day spikes are rare, meaning volatility tends to stick around a little bit after big shocks to the system like this. And traditionally, what we do typically see is that, on a big bounce like this, where it bounces a little bit higher, a few weeks later, you do have the propensity for equity markets to revisit, the lows that were initially formed. So 5120 on the S&P 500. We're trading at 5,300 now, or close to 5,300 now. We could very much see over the next couple of weeks perhaps volatility expand a little bit and revisit 5,100. But that is largely our base case here at the moment. And there's a few other things to kind of back that up here as well. If you look at the bond market right now, we look at high yield, the spread between high yield and investment grade in terms of bonds. It's we have seen that spread elevate a little bit this week, but as you can see in the historical context of when things get stressed, right now we're nowhere near kind of some of the stress levels that we've seen, right? This is the dot-com boom. This is the 2008 financial crisis. You have a couple of contagion risks in between there. You have the COVID lows, and look at where we are now. right? So this is where we are now. We've started to retreat here again today already. So the fact that we expanded up to about 3.5% yield difference between investment grade and high yield, and it's started to fall a little bit already, leads me to believe that at least at the moment the bond market is now pricing in the recession word that kind of was brought into play on Friday's unemployment number, because technically at trigger one of the economists um, recession rules in terms of the number the print that we saw, but bond market so far does not seem to be pricing in further contagion risks with the equity markets. So, you then also take a look at the fact that the S&P 500 in terms of corporate earnings, if you look at calendar year 2025, bottoms up EPS, we're talking about all-time highs in terms of expectations for corporate earnings. So you have a lot of data points here between the VIX, between what the bond markets are trying to signal, between where truly the S&P 500 in terms of earnings are. It typically doesn't suggest, a market that's weak, that's at risk of falling substantially from where we are right now. So that's why when I look at the broader markets right now, when I look at kind of the markets, my expectation is that you might get some weakness here over the next few weeks, but that weakness largely will likely be contained to that 5,100 downside on the S&P 500. Now, if we break 5,100 on the S&P 500, first of all, my guess is that it would take a bigger catalyst to actually make that happen. Right now, the biggest risk probably is with the Fed. The markets are pricing in a 50 basis point cut in September. If, let's say, the Fed chooses not to cut 50 basis points, maybe they only cut 25 basis points, that is a potential catalyst, where the markets are expecting something and the Fed doesn't deliver on that. That is a potential catalyst for markets to move lower. Other than that, you really just have to see, the U.S. employment picture, the labor picture deteriorate fairly substantially, in my opinion, in order to kind of create that catalyst to drive things lower. Because corporate earnings are strong. We had a mixed season, but that's because earnings expectations, I would say, going into the season were too high. Analysts have already cut expectations for next quarter at a faster than average rate, which means that we have a higher probability that more companies will beat on earnings next quarter. The outlook going out 3 months into the next earnings cycle at the moment still looks quite positive. So overall, you don't have the makings, if you will, of a bear market just yet. Certainly some volatility, but not the bear markets. So we do have to factor that into when we think about kind of expectations. And this is the probability of rate cuts. So we're currently at 525 to 550. So in September, right now, the highest probability that the bond markets are pricing is down to 475 to 500, which is an equivalent of 50 basis points, 55% probability of that happening right now. In November, we're looking at a 52% probability of another 25 basis point cut. And then in December, a 47% chance of another 25 basis point cut. So that equates to 100 basis points in cuts between now and the rest of the year, which also is supportive of equity markets if interest rates were to decline by about 100 basis points between now and the end of the year. So, with all of these things in mind, like I said, it doesn't provide the backdrop of substantially lower markets. Okay. So hopefully I wanted to try to get that out of the way. A lot of investors have been asking, should I be selling into rallies? Should I be concerned about a lot more downside? Should I be getting out of my stocks? Should I be moving into cash at this moment? Based on where we stand right now, it doesn't quite look that way. Can things deteriorate? Sure, but that's why we're here every single week, every single Monday to keep you abreast of these macro conditions, these macro indicators, to give you a better understanding of where we currently stand. Monday was, by all means, a very ugly day, a very violent day that probably many of you have seen losses in your portfolio as a result of it. But I will say it's how you react to it that will determine, how successful you are as a trader. And this week, multiple opportunities to get into the markets. And I think we need to take some of those opportunities to get into the markets right now. Okay, so let's take a look at bear market stats. And we're going to talk about this just so that you have some information about it, not necessarily because we believe that there's a bear market coming, but remember that bear markets decline of over 20% from, like how we define a bear market is if the market declines more than 20% from its peak. Typically, you have higher market volatility. In this particular instance, we're not 20% down from the peak. The NASDAQ 100 on Monday did open up technically in bear market territory and very quickly recovered from that by Tuesday. While we're not in a bear market now, the NASDAQ 100 could turn into a bear market if it does break below the Monday low. So that is one thing to keep in mind. It's more of a technical term, more so than anything else, simply when it's more than 20% from its peak. But the one thing to statistically remember is that markets trade higher 60% of the time and lower 40% of the time. So statistically speaking, you have an advantage to being long the market than being short the market. And if you're going to be short the market, you better be more nimble with those shorts than you are with your longs, because markets don't stay bearish as long as they do stay bullish. And that's an important thing to remember. But probably the more important thing here is not just in terms of time, but markets tend to sell off faster than they climb on rallies. As they say, markets take the elevator down and the escalator back up, meaning they fall very, very fast at the downside and then take a much slower grind to get back to where they are. So those are some of the things that you have to factor into, the timing of the markets, and also what type of option strategies make sense given the type of the type of outlook that you might have on a given security. So with that, let's talk a little bit about kind of bear market trading. If you are to trade a bear market, meaning if you are trying to push shorts in the market, remember that risk to reward favors waiting for rallies. So let's say a stock is bearish, waiting for rallies before you enter a bearish position. And this is all about skewing risk to reward in your favor, because if you wait until a rally to sell, the goal of waiting for a rally is that you want to basically target a fairly sizable downside target, and at the same time have a relatively small amount of risk on the overall trade. And this is a chart of Royal Caribbean. This is an old chart, but it doesn't really matter because it's for illustration purposes. The idea is that wherever you enter, you want to understand where is their prior support, because that could be your potential target to the downside. And then you want to understand what was the recent highs, right? So for example, if the recent highs on here was around 52.5, you generally want to understand that if it breaks out above 52.5, then your bearish thesis is likely not working out. You want to cut your losses. And what you want is, how far does the stock need to move before you would say, I'm wrong and I need to cut my losses? And how big is that in relation to how far the stock needs to go in order to hit your take profit? So what you can do here is using rallies to kind of find opportunities where the risk to reward is skewed as best in your favor, because bear markets are not easy to trade. Statistically, it's skewed against you. You tend to get these moves that are fast and violent, which means that you don't have necessarily a lot of time to get into these trades and get out of these trades. So they're very time sensitive. So in order to do so, you want to do so in a way where your risk reward is skewed as heavily in your favor as possible. Um, Technical indicators can be utilized to determine when rallies are overbought, and you can sell into them. And that's for if you're trying to follow the bearish trend or follow the bearish market. However, another thing that you have to also consider is that as markets fall, the further it falls, the more attractive they become for buyers, right? If the markets fall, that means stocks are trading at lower valuations. They are, we've all heard the old term buy low, sell high. Well, how do you buy low? You wait for markets to sell off. You wait for bear markets. That's when you buy low. So when you do get into a bear market, you got a lot of investors that are now looking at that as a buying opportunity. So that is also, a trading strategy for bear markets that I think a lot of traders kind of overlook. When things get ugly, we're all thinking about shorting the markets and how much further markets can go. But by being a bit contrarian and, as markets get really volatile and as they get scary, thinking about being a buyer is actually the right framework to go about thinking about this. So what I wanted to show you here today is two scans that we built in OptionsPlay to help you do exactly that. One, when you're following the bearish trend, meaning you think that the markets are going to continue moving lower, well, how can you find opportunities that um, give you a strong risk to reward for markets to continue lower? And then more importantly, where can you find bullish counter trend trades, meaning stocks that have sold off so heavily that they now actually become buying opportunities? Now, these are new scans that we recently just published into our OptionsPlay platform. What I want to spend is a few minutes here today walking you through it and taking some questions with regards to how to utilize these scans. So in your OptionsPlay platform, you have technical ideas here in the upper left-hand corner under ideas. Now, I encourage all of you that are using OptionsPlay to spend some time familiarizing yourself with the ideas section. There are lots of different ideas that we publish. We publish technical ideas, which are based on technical indicators. We publish cover call ideas, credit spreads ideas, short put ideas. These are all income focused scans where we effectively are looking for opportunities where you can generate the most income using those types of option selling strategies. But for today, what we're going to focus on is on the technical scans to help you navigate it. And we've recently made some changes to the technical scans to make it a lot simpler to navigate, a lot simpler and easier to use. So first thing what I like to do under technical scans is I like to sort based on relative strength. Because when I see a list of stocks, I like to know what are the strongest stocks and what are the weakest stocks. So the strength metric is one of the easier ways to go about doing that. So whenever you look at any watch list, you look at any list of trade ideas, I can sort it based on relative strength so that I can know kind of the weakest stocks are at the top, the strongest stocks are at the bottom. And then what we have here are a list of filters that you can filter your scans by. And what we have recently done is we've basically simplified our scans to scans that make more intuitive sense for most investors. We have bullish and bearish trend following trades, bullish and bearish counter trend trades, and then we have a couple of other scans that are in here. I have a CCI rally and bearish trend and a CCI dip and bullish trend. And those are ones that I recently covered in my trend following webinar. But it's a scan that I have used in my trading in my last 18 years or so of trading. It's one of the scans that I've used predominantly in finding kind of some of the best trading setups. But these four scans we built to try to make it a lot easier for traders to navigate different ideas, right? There's lots of different ideas out there. There's lots of different ways that you can use technical indicators and parameters and to find ideas. But ultimately they all fall into one of these four categories. You're either trying to identify a trend and follow that trend, or you're trying to identify a trend that's coming to an end that you think is going to reverse in the opposite direction, right? All technical indicators You know, all technical trading strategies, you know, fall into one of these two categories, and you can either trade bullish or bearish, right? So when we're in a volatile bear market, you generally are looking at you know, following a bearish trend, if let's say you believe that trend's going to continue, or you might look at bullish counter trend because you believe markets are kind of near a bottom and it's now a buying opportunity. Okay. So like I said, given the market conditions that we're in right now, I don't necessarily believe that trend following a bear trade is the right trading setup. I think that if you are going to take a bearish trend following trade, you can, you know, as a speculative trade, because maybe you're concerned that things can get more worse. Or things can get worse, which is why you want to take a bearish trend following trade. But I certainly would keep my size relatively small on those trades at the moment, and then maybe focus more of your attention on some of the bullish counter trend trades. So let's just look at the bearish trend following trades. Right now, there are not many. But you know, as you can see, as you can imagine, the reason for that is because there are not a lot of bearish stocks that have rallied enough to justify selling them just yet. So we'll keep an eye on this over the next few trading days for any opportunities that come up. But Ball Corp is an example of this, right? This is a stock that recently turned bearish in terms of trends, right? Declined from $70 to $60, rallied back up to 65. And that is your potential opportunity to seek a bearish exposure here in Ball Corp, right? So the technical indicator is trying to identify for you stocks that have turned bearish, meaning, as you can see, this is a stock that broke some support, right? Broke some support around 65, turned bearish, rallied back up to 65, and maybe you're concerned that this stock will continue moving lower here. And if that is the case, this would be a good entry opportunity to take a bearish position in Ball Corp, right? And then you can always use the OptionsPlay platform to help you identify a bearish trading setup, whether that's buying a put option or a debit spread or even a credit spread. You want to sell that. You can easily structure that here in OptionsPlay without having to pull up an options chain. So our goal here at OptionsPlay is to help you identify trading setups through our technical scans in just a few seconds, and then more importantly, help you structure an options trade for that bearish view also in just a few seconds. So for example, if let's say you're taking a neutral to bearish view here on Ball Corp, you can use something like this credit vertical spread that's already been set up for you. The exact expiration date, strike price is all set up for you. You can analyze it based on the maximum risk and reward as to whether this suits you before you click on the trade button and execute this trade either into your broker's platform or into your TradeStation account directly from your OptionsPlay platform. You can also even paper trade these types of trades. So for example, if you want to create a portfolio for paper trading, you can do so. And you can simply add this this trade to a specific portfolio that you've created. So if let's say you want to track this September 2060 67.5 call vertical that you collected 72 cents on, you can click on add position, and this will now show up into your portfolio that you can try out in terms of tracking this specific position and see how it plays out over the next few weeks. But the technical scans are designed to help you find these types of opportunities. But like I said, right now, what I think the better opportunity right now are kind of the bullish counter trend ideas. And you can even sort out and filter out kind of some of the not so liquid names. I usually start my research with the most liquid names first. And then if I don't find anything in there, that I might go into somewhat liquid, but I generally will always stay away from symbols that are not liquid because I won't be able to trade options on them. So I generally don't spend a lot of time looking at stocks that I can't trade options on. So looking at kind of, as you can see, there are 60 ideas, right? There are a lot of stocks that are very oversold, you know, with a really poor relative strength that are potential bounce opportunities. And this platform basically helps you identify that. So for example, we actually highlighted in our Monday research CrowdStrike. CrowdStrike opened up the week at 202, and we identified it as a potential bullish opportunity. And just a few days later, the stock's trading at 240 right now. This stock easily, as you can see, this was a $400 stock just a few weeks ago. The fact that it went from 400 to 200 in such a short amount of time is what makes it a candidate for that potential bounce opportunity. Even if it bounces halfway to 300, you still have a good amount of room here to the upside for CrowdStrike to continue to move higher here. I'll take a look at something like Lululemon. We've also highlighted Lululemon recently in our research, trading at a much more reasonable valuation considering this was a $500 stock. At the beginning of the year, now it's trading at roughly 200 or so, 200 and change, 227. It's just starting to move its way up. The goal here with these types of counter trend ideas is to try to capture that turn in the trend as early as possible. And many times we're capturing it within a day or two of the actual turn, right? Like, when investors talk about outperforming, how do you really outperform? You can't outperform following a trend, because by definition, if you're following a trend, it means you're already late to the game, right? You're kind of behind the curve a little bit when you're following the trend. The only way you can outperform is by being early to the trend. And that's exactly what bullish counter trend ideas are trying to identify for you, are stocks that are potentially very, very early in the trend, literally at the very beginning of the trend. That's what we're trying to identify, and that buying opportunity, so that you have the most favorable risk to reward ratio as possible, right? If you look at Lululemon, even if it resumes back to 300, right? How much risk do I have to take to play, this potential move back up to 300? It's currently trading at 220 to 241 right now. If it goes below 225, I would say I would get out of the trade and move on, right? So that's $15 worth of risk. And then the upside here from 241 to 300 is $60. So we're talking about a risk reward ratio of about 4 to 1. You're not going to find trend following strategies with a 4 to 1 risk to reward ratio. You're only going to find counter trend ideas with those types of risk to reward ratios. Now, counter trend ideas are going to be less successful in terms of number of trades that are profitable than trend following trades, but the risk to reward is far more favorable in counter trend ideas than you do with trend following ideas. And our platform is designed to help you identify both of these. And depending on where we currently sit in a bear market or in a volatile market, you generally may want to skew towards using one type of scan versus others. And I think given the market conditions that we're in right now, with equities selling off pretty heavily, but finding some stabilization, these bullish counter trend ideas are at the moment kind of where we are leaning on finding some of our ideas at the moment. So you can quickly sort through this list and find some of the ideas. This is where we found NVIDIA, where we took a bullish trade here. We've also taken Alphabet position here based on this particular scan. And as you can see, if you look at kind of the stocks with the poor relative strength, there are a lot of different names in here that you might recognize. Look at Pinterest. Pinterest sold off pretty heavily here. The past few weeks, this was a $45 stock. That's now a $25 stock. Do I think Pinterest is the right opportunity? Not necessarily, but look at some of the other names here that I think AMD is an interesting one, right? You see kind of AMD take a fair amount of market share away from Intel. I think that they're likely going to continue to take market share away from Intel. The fact that it traded to a new 52-week low here, I think is an opportunity for potential buyers to step in here for stocks like AMD, especially if you believe in kind of some of the the strength here in terms of AI and the beneficiaries of that, which are the chip stocks like NVIDIA and AMD. Carnival Corp, similar type price action here. This is a $19 stock that's shed, nearly 30% of its value in 2.5 weeks, which is a huge amount of value to shed. Is this going to be a bounce potential here? Up 3.5% when the market's up less than 2.5%. So you'll see a lot of stocks in this list, that are outperforming the market here. Align Technology is up 5%. You have AMD up 6%, Intel up 7%, Snowflake up 6%. This is the list of stocks that you would want to play for a bounce. Lam Research up 7%, Microchip 7%, Western Digital nearly 5%, Freeport-McMoran 3.8%, Dell 4%. Applied Materials 6.7%, Delta 6.19%. Looking for stocks that are going to bounce faster than the rest of the market, this list is a pretty good starting point to help you identify those stocks. Now, I always tend to use a layer of fundamentals in addition to the technicals to help me filter through some of the technical ideas. But the technical idea list is where I start my research. This is where I kind of look for stocks that are oversold, have that bounce potential. And if I like it from a chart perspective, that's when I look at the fundamentals. If I like the fundamentals and I still like it, that's when I'll turn to the options. Now, in this type of market environment, options selling is certainly going to be more favorable. As you can see, the IV rank on stocks like Carnival Cruise, 59%. So relatively high implied volatility, which is why I would use, high implied volatility strategies, such as selling a credit spread or even sometimes selling a straddle if I'm more neutral on a specific security rather than bullish. But this is really where you can structure your trading setups based on your views on the markets. So for example, let's say you want to take a bullish view and you want to trade a debit spread instead of selling a credit spread, you can, a click of a mouse, be able to do that. Or if let's say you're just starting out and you're only familiar with buying call options, being able to see the call option next to the stock or seeing the call option versus the vertical spread and making the comparison is going to help you better understand each strategy and what your risks are before you actually execute a trade. So as you can see, the platform is designed to help you make your ability to find ideas very, very quickly. These ideas are refreshed every single day. So when you log in every single day, you're going to see a new list of ideas. And we want to make sure that you have access to the right ideas for your trading. And like I said, we try to be we try to be as we try to provide a platform that gives you all of the underlying data at your fingertips so that you can do the research yourself. We pull from these lists when we put out our ideas for the week. If you look at my Monday macro research Monday morning macro research list, where we put out anywhere from 3 to 6 or 7 different ideas. These are ideas that we generally pull from this specific platform and this list of stocks, because this is really where we do our technical research and our screening. And once we like a specific stock, we want to make sure that we also like it from a fundamental perspective. And if we like all of that, then we come here and try to structure the right options trade. Regardless of whether you're looking to buy options, whether you're a beginner or you're more advanced, we cover all of these option strategies so that by the single click of a mouse, you'll be able to see these strategies and get a good starting point as to when you might want to buy a call option or potentially sell a put option or a credit spread on a bullish stock that you might have from our scans. Let's take a look at a couple of things. Position sizing. When things get volatile, it's extremely important, and this is important at all times, but even more so during volatile times, is to make sure that you calculate the number of contracts based on the max risk of each strategy. And generally speaking, you don't want to exceed more than 2% of your total discretionary account per trade in your max risk. So let's go back to this Carnival cruise trade, right? Let's say I think that this is going to bounce and I want to sell this credit spread. So one of the things that I can do is I can use the risk and investment calculator here at OptionsPlay. And how many of you have used the risk and investment calculator in OptionsPlay? Type yes into the chat window if you've used that before, because this is arguably one of the most important tools in your trading toolbox, because it allows you to select how much you're willing to risk, right? Let's say you're willing to risk $2,000 on a trade. You click on calculate, and it's going to calculate the appropriate number of contracts for you so that the max risk on the specific strategy is what you deem it to be, right? So that no matter what happens, it doesn't matter where the markets go, whether they end up 10% higher, 10% lower, they stay where they are, the most you'll risk on this particular trade is $2,000. Now, I always advocate that you use this specific tool here. You can adjust your defaults in your profile, right? In your profile, you can basically set what is your portfolio size. Let's say you have a $100,000 portfolio. We always suggest that you never risk more than 2% of your account per trade, and you save this as default so that every time you use the application, it'll always default to risking $2,000 on a trade. So all you do is simply click on the calculate button, and it will calculate the appropriate number of contracts that fell on any of these positions. So for example, if I'm looking at CrowdStrike here before, and I'm looking at maybe buying a call option here on CrowdStrike, I'll be able to quickly understand, how many contracts I can trade. This is telling me I can only buy one contract, right? Or if I'm looking at Pinterest here, and I'm thinking about buying Pinterest here, and I'm looking at buying those call options, I click on risk, click on one click, and it'll tell me I can buy 8 contracts of this call option. And if I buy 8 contracts, my max risk is $1,832. The goal here is to make sure that you don't blow up your accounts during volatile times. It is very common to see accounts take significant losses during volatile times because they haven't managed their risk properly. They haven't managed their trades from a sizing perspective. So it's really important that for those of you that are trading, in a volatile time, but even during non-volatile times, but even more so during volatile times, is that you stick to rules like this, because these rules are going to prevent you from blowing up your account. I can't stress enough how many times I see when things get volatile, people panic and they trade, all types of strategies to try to make their capital back. And in doing so, that many times they don't factor into some of the more important things like their risk tolerance and their rules for the number of contracts. So incredibly important tool that's available to you here at OptionsPlay to help you find the right position, the right contract size. And then lastly, never add to a losing position. This is a rule that I think every investor should learn, because a lot of times, especially in a bear market where stock goes in your favor, you think you're winning. Next thing you know, the stock has moved a little bit against you, and you see your position is now in the red. What do? You maybe buy back that option, or if you've bought the stock, maybe you sell it. But the goal here with trading options is so that if a trade is not going in the direction that you expect it to, that you never add to a losing position in hopes that by adding to the position, you've reduced your cost basis and the stock doesn't have to move as far in order for your strategy to break even. So everything that we do here at OptionsPlay is to help you find the right opportunities, structure the right trades based on kind of available best practices, and then more importantly, help you make sure that you stay on top of your positions. So once you have a position that you're looking at, let's say we're looking at this Pinterest trade and I'm looking at buying a debit spread, I can click on the trade button, enter the trade in my paper trading portfolio, and click on add my portfolio. Or if you have a TradeStation account, you can actually link your TradeStation account in OptionsPlay, and you can execute your trades directly from the screen into your into your TradeStation account. We're looking to do more of these broker integrations here in the fall of this year. but we are very excited to offer TradeStation as our first broker that allows you to execute your trades directly from OptionsPlay so that you don't have to leave our platform to trade options. So with that, that covers what I wanted to share with you here today. We went over a lot of stuff here during today's session, helping you better understand just the current market conditions. But with that, that's going to help you better understand what type of opportunities make the most sense in this type of environment. So between trend following versus counter trend, my take is that counter trend is likely going to perform a little better here over the next few days or over the next few weeks. Even though we expect a little bit of volatility, I do think that when you get to these lows, if you are able to utilize options to give you the ability to purchase some stocks at a lower price, that's really some of the cool possibilities that you can achieve with kind of what you've learned here today and the tools that are available to you here at First Rate. I'm here at OptionsPlay. So if you want access to the platform that I just showed you here today, you can sign up for a free 30-day trial at optionsplay.com/sign up, or you can point your phone to the QR code and it'll give you access to the screeners, right? So finding those bearish screeners, those counter trend screeners, access to the option strategies so that you can quickly structure an options trade on the back of it. And then the risk and investment calculator, incredibly important tool in helping you stay in your lane and not blow up your accounts, because during these volatile times, that's when we tend to see some investors suffer large losses in their portfolio. And there really should be no reason for that, because you should be sizing appropriately before you get into any trade, before you get yourself into any trouble. And the best way to do that is to have a tool that basically automatically calculates how much risk you're willing to take, and on a single button will actually calculate the appropriate number of contracts to help you stay in your lane. So with that, let's open this up for Q&A here. There is a Q&A window and a chat window at the bottom of your screen. If you could, please type your questions into the Q&A window. I'll try to answer as many questions as I have time for during today's session. How far do you chase a position? For example, with NVIDIA, the daily play early this week, you recommended before the market had opened, but by opening it had changed by $1. Is it still a viable trade? I generally say, like, if the move is less than 2-3%, it is still a viable trade. You can anything above 4 or 5% is really kind of where you don't necessarily want to chase it. But a buck on NVIDIA, which is 1%, definitely still a valid trade. And we do update our strike prices and builds on when the market opens, right? So, we put out the research before the market. We obviously don't necessarily know where the market's going to open the next day, but we do put out some research to help you better understand, kind of how to go about doing this. This recording will be made available on Sunday. So you can find us at youtube.com/optionsplay. This is our main channel. We are now starting a secondary channel as well. The main channel will have kind of these full webinar recordings. So like the full hour, you'll see them on the main channel. We have started a secondary channel where we basically have taken clips from our full webinars, so that if you just want to take snippets, you want to learn in bite-sized pieces, you'll be able to do that. These are 5-10 minute video clips to help you better understand individual concepts rather than kind of listening to a full webinar on a specific topic. The platform is great. Is there a way to estimate the expected value of a trade given the probability of range and P&L over it? Great question. So the question is kind of, can you get a sense for expected value of a strategy? And that's exactly why we built the OptionsPlay score. The OptionsPlay score is designed to give you a better understanding of the expected P&L weighted by the probability of each outcome. The higher the score, the better the expected value of the trade. Let me see if I can find you another one. Let's look at Lululemon. As you can see, the expected value of a stock is very close to 50-50, which is why you get a score close to 100 on a stock position. The call option, you have a lot more probability of losses and a small probability of gain, even though the gain upside is unlimited. But that's generally why for a single leg option, you generally will see a relatively poor expected value because of how much premium that you have to pay to get a long call or a long put. And then you generally will see better expected value on spreads relative to single leg. Whether you're comparing a single leg to a debit spread or a single leg to a credit spread, you generally will find that the vertical spreads will give you slightly better risk to reward because it is able to reduce your overall risk on the trade. So that is exactly why we created the OptionsPlay scores, to help you better understand expected value. What does strength 1 through 5 mean going up in strength or down? I'm not sure what you mean by 1 through 5. So our relative strength score goes from 1 to 10. 1 are the weakest stocks in the market, and 10 are the strongest stocks in the market. So let me see if I can help you find. So Lululemon, right? As you can see, this was a $500 stock that's now trading at $200. This is a stock that's declined substantially in the last, call it 8 months or so, during which time the market's kind of continued to move higher, which is why Lululemon has one of the worst performing opportunities. It's got a score of 1 of the worst performing stocks in the market. And then if we scroll all the way to the bottom of this list, look at Robinhood. It's got a score of 10. This is telling me this is one of the best performing stocks in the overall market. And if you look at kind of where it's held up here, that's really kind of why Robinhood is a score of 10 over the last call it 6 months or so. This was an $8 stock that's now trading at $17. So even though markets are choppy or markets are volatile, the stock is still up over 100% here in less than a year. So those are some of the things that are factored into these types of into every trade idea, so that you understand technically speaking, fundamentally speaking, and just having a tool that can help you structure an options trade so that you don't have to pick your own expiration dates and strike prices every time. That we've optimized the strategy already for you, so that you can just basically find an idea, click a symbol, and potentially get trading with that strategy fairly immediately. Most of these trades you suggest we buy at the end of the day? No, not at all. Basically, I would say it's far more common for traders to buy or enter a trade at the beginning of the day than at the end of the day. I tend to always wait until the open before I enter any new trades. I usually don't like to keep open toes. We generally want to keep these trades at the open for the most part. You generally don't want to leave these till the end of the day in terms of executing these trades. Is it possible to insert your own prices when using the P&L simulator? If you're saying, can you enter your own prices in the P&L simulator here, meaning let's say if you bought this call option at $2.40 instead of $2.50, the answer is no. But when you go to trade, you can change the premium. So for example, let's say you open this at 240, the risk and reward stuff is recalculated for you based on your the price that you've entered. And then so that this obviously is so that when you enter a trade into your portfolio, you can enter it based on an actual trade, an actual price that you were executed at, right? So if let's say you go into your platform right now, you go to execute this trade, and you get it filled at $2.38, you can enter that at $2.38. select your portfolio, enter it, and now it will be tracked in your portfolio based on your actual cost basis. Please clarify the scoring on relative strength. So relative strength are always on a score of 1 to 10. 1 are the weakest stocks, 10 are the strongest stocks in the market. IV rank is implied volatility rank out of 100. So that tells you how expensive an option is, right? A score of 100 means it's the most expensive we've seen in the last 52 weeks. A score of 0 means it's the cheapest we've seen in the last 52 weeks, and a score of 50 means that it's right dead center in regards to where we've seen volatility trade at for the last year or so. So high IV generally tends to favor option selling strategies. Low IV tends to favor option buying strategies. Now that's a bit of an oversimplification, in my opinion, of volatility, which is in itself a bit of a complex topic. But if you kind of want a simple explanation of what IV rank is, that's generally it. For counter trend ideas, typically, what type of time frame are you looking to exit the trade? So that's actually a really great question. Like Ken's asking, if you trade a counter trend trade, how long how long might you want to stay in it? Well, what's interesting about counter trend trades is that if you truly get into a trade early, that trend can trend forward for a long time. Which is why I don't particularly typically like to set a specific time, right? It's really more so based on a target price based on technicals and fundamentals that I would set. Because it could take months and months and months to get there. And as long as it takes more and more time, I'll continue to sell options or potentially buy some options depending on whether they're cheap or expensive. But the goal here is to um, uh, but the goal here with these kind of counter trend ideas is to stick with the trend for as long as possible. So you can sometimes find yourself entering a counter trend trade and just continuing to roll the option that you're in for months on end, and you're really able to capture a pretty significant upside here. And like I said, the only way to outperform the markets and outperform your peers is to look at counter trend ideas. Trend following ideas are neat. They are relatively easy to understand, but what they don't provide you with is, a large opportunity to outperform. You kind of really just either perform on par with the rest of the market, or maybe sometimes even underperform a little bit, because by definition, following the trend means that you're sort of later. You're there later in the game. There's a question here from Doug saying, can I screen for specific deltas or risk to reward ratios? You can on credit spreads. You can't sort by deltas, but we can sort is based on risk to reward. So you can do that here under credit spreads. But we're not going to cover kind of the technical, the options ideas today. We're just going to cover the technical ideas for today's session. The free trial is a 30-day free trial for the platform. A question is saying, wouldn't selling cash secured puts on some of these stocks be an exception to your 2% rule? Sort of, right? Generally speaking, with equity positions, we'll risk up to about 5% of our total account value, rather than sticking to a hard and fast 2% every single day for selling options. But for cash secured puts, we generally will risk up to 5% of the stock's value. Now, you might say that if I sold this for $5 if you sold this a cash secured put and you risk 5% of your total account value, the chances of the stock losing 5% of its value is lower than an option losing 100% of its value. So that's why when we think about these types of strategies, if you look at kind of our NVIDIA trade, our maximum loss, at two standard deviations wasn't much more than 2,500, which is why we chose it. But any higher price stock would have been a bit of a challenge here for us by selling cash secured puts. Um, if you currently have a Fidelity account, you can get a discount to the options form, and you can sign up through the Fidelity account. You can go to fidelity.com, go to options, and you'll be able to see the OptionsPlay offer that will take you directly to our offer page that you can use to sign up. And if I'm not mistaken, it's optionsplay.com/fidelity. Lulu CCI is negative. Why is it a buy? Well, negative values are a good thing for technical indicators, right? When technical indicators are negative, those are potentially buying opportunities, right? Buy low, sell high. Not every low indicator is a buying opportunity. We generally want to see the stock and the meet or you generally want to see the stock um, uh, you want to see the CCI dip negative and then use that kind of negative reading potentially as an opportunity to buy, right? Because negative readings correlate to oversold, and oversold are, buying opportunities, I think is the better way to think about it. I only buy stocks with a strength of 10. No, strength of 10 just tells you those are the strongest stocks in the market, but those are by no means the only ones that you should trade. Have you heard about NYSE initiating a dialogue about transitioning to 24/7? First of all, I don't think any markets like this will ever transition to 24/7. You might transition to 24/5. We now have 24-hour trading in a lot of the ETFs at some of your brokerage firms. Global markets largely are open, making a market in that stuff. So I do think that, eventually you're going to see more 24/5 trading. At the very least in popular ETFs and single stock, but I don't necessarily know we're ever going to get to 24/7. Okay, with that, that covers what I wanted to share with you here today, and that's all the time that I have for questions. I really hope this was helpful in number one, framing for you kind of where we currently stand in the broader markets and how we're thinking about the data. Some basic understanding of bear markets and how to screen for ideas using our platform. And I hope that you find this useful in your trading and helping you navigate some of the volatility here over the next few weeks. Otherwise, I will see you guys here on Monday morning. I will give you a update on kind of where we currently stand with the overall markets and our daily play portfolio and present to you new ideas on Monday morning. So I hope that you'll be able to join me for that. With that, thank you so much. I hope you guys all have a great trading day.